This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. We start today's show with Dave Sally, then we go on to Andy Bush, a political economist, and then to former Fed insider Danielle DiMartino Booth, and my chat with Matt Hendricks of Sprott Asset Management. And after the news, a short interview with Eric Nuttall, who is the portfolio manager of the Sprott Energy Fund. On to Kevin OLeary, chairman of the OLeary Financial Group. Then a tech focus. Daniel Morgan, senior portfolio manager, Synovus Securities, comments on Facebook's earnings, and a further comment on Facebook by Christina Parts. And we conclude today's show with John Petrides, who's managing director and portfolio manager at Point View Wealth Management, and he comments on the Amazon and Alphabet earnings. But first, to Dave Sally of the Ottawa Business Journal. It's a pleasure to welcome Dave Sally from the Ottawa Business Journal back to Money Talk. And Dave, you've had a week's holiday, and I understand you had a great time in Washington, D.C.
I did, John. It's a terrific city. So many things to see and do there. Tried our best to take in as many sites as possible. It was a little on the warm side, but that's to be expected, I guess, in July in the south.
Dave, two high-profile Ottawa firms saw their financial reports heading in opposite directions in the second quarter, while there was some positive news for the city's housing market this past week.
That's right, John. Well, we'll start with Telesat, which announced its second quarter financial results on Tuesday. The satellite communication service provider reported revenues of $232 million Canadian for the three-month period ending June 30th. That's up about $5 million from the same period a year ago. Telesat attributed that rise to a 4% increase in the value of the U.S. dollar over that time. That's important for a company like Telesat, which earns a lot of its revenues in U.S. dollars, but reports them in Canadian currency. So adjusted for currency conversion rates, Telesat's revenue was up by about $1 million in Canadian terms. The company's net income was $62 million during the second quarter. That's up from $56 million during the same period in 2015. It credited that increase to the rise in revenue and a drop in operating expenses, which fell about $2 million from the same period last year.
However, the news wasn't as good for another Ottawa company.
Yes, that's right, John. On Thursday, Wylan said its revenue dropped by more than half during the second quarter of 2016 compared with the same period a year earlier. The patent licensing firm reported revenue of $16 million U.S. during the three-month period that ended on June 30th. That's down from $35 million U.S. during the same period last year. The company blamed the drop on a larger number of fixed-fee license agreements that were signed a year ago, particularly a multi-million-dollar deal with Samsung. Wyland CEO Jim Skippen told investors such ups and downs are, quote, just business as usual for us, unquote, noting that license agreements often vary from quarter to quarter. Wyland reported a net loss of $3.2 million U.S. for the second quarter, down from a net income of $11 million U.S. during the same period in 2015. Mr. Skippen also said the company had acquired a patent portfolio for the technology used to develop Siri. That's the voice-activated personal assistant software on many of your phones. And the company also signed partnership with the University of Waterloo and the University of Saskatchewan.
And finally, the Canada Mortgage and Housing Corporation says things could be looking up for Ottawa's housing market.
Yes, John, a new study by CMHC says Ottawa's housing market is showing less evidence of what it calls problematic conditions than it was 3 months ago. Those problematic conditions include overbuilding, overvaluation, overheating, and price acceleration. CMHC said its housing market assessment for the third quarter of 2016 found little evidence of most of those conditions in Ottawa. Analyst Anne-Marie Shaker said there was some moderate evidence of overbuilding in the city, but CMHC says generally there's a balance between supply and demand in Ottawa's housing market right now. Slightly lower demand and a rising supply caused prices to fall a bit in the first quarter of 2016, the report said. And CMHC said that decline in prices, along with an increase in employment and weekly earnings, has reduced overvaluation fears in Ottawa.
And Dave, what is on the OBJ radar for the coming week?
Well, John, earnings report season continues in full swing. Among the local companies that will be reporting their financial statements this coming week are Calian Group, Halogen Software, and Kinaxis, all of which will announce their results on Thursday.
Dave, it's good to have you back. Then we'll talk again next Sunday, 2 p.m.
Well, thank you very much, John. Always good chatting with you.
Now to political commentator Andy Bush from Chicago.
This woman has never been satisfied with the status quo in anything. She always wants to move the ball forward. That is just who she is. She's insatiably curious. She's a natural leader. She's a good organizer. And she's the best darn change maker I ever met in my entire life.
That was former U.S. President Bill Clinton at last night's DNC. It was a historical night, with Hillary Clinton becoming the first woman to be nominated by a major party to run for the White House. But our next guest says the moment has been marred by treachery and deception behind the scenes. Joining us now on the line from Michigan is BNN contributor Andy Bush, political economist at andrewbush.com. Andy, do give us your details and your thoughts here. Deception behind the scenes. What are you talking about?
Well, I think the release of all the Democratic National Committee's emails detailing how they favored Hillary Clinton in the primary showed that the head of the party really put her finger or put her thumb on the scales to help the Clintons out. And that's one of the reasons why for the first 2 days you saw a lot of the Bernie Sanders supporters being very vocal and yelling and just talking about and yelling shame, things like that. So this is, as far as conventions go, both the Republican and the Democrat conventions are the best reality show I've ever seen in my life, with the exception that, of course, at the end of these things, eventually, we're going to elect the leader to the world's most powerful country, so it's a little bit disconcerting. But both conventions had intrigue, deception, so it's really been a lot of fun to watch.
Well, I suppose. But, Andy, it's interesting that you're focused on those emails, those email leaks. I mean, I am too, and I would be, but I feel like it was so long ago now. It seems as though it's already been put to the side, shockingly. But, of course, I would assume that Trump is going to do something more with that, and maybe they're saving the best for last. Wait till November to really give it to them in terms of these potential leaks. That's what I'm hearing people talk about.
Right. So there's two interesting storylines with the emails. One is that they will release additional ones closer to the election to derail the Clinton campaign. That's certainly likely to happen. But the second one that you probably haven't heard much about, a very well-respected conservative editorial writer, George Will, here in the United States, has said that he believes that perhaps one of the reasons why Trump has not released his tax returns is because he's doing business with Russian oligarchs. So there are some interesting storylines on both sides of the aisle here that could hurt both of the campaigns. So I'm sorry if Canadians are looking at this. If Canadians are looking at this like this is absolutely insane, you're correct. I've not seen anything quite like this. But the other thing I just want to point out, too, is that both parties have come out against big business overall. Yeah. And that's pretty surprising. I mean, usually the Republican Party has been very big backers of the U.S. Chamber of Commerce, not so much anymore. And both parties have come out for something called a return to Glass-Steagall for the banks and breaking up bigger banks. So I think that's something that will continue to move forward. It won't matter if it's Trump or Clinton in the White House.
Andy, it's interesting that you say that this writer is talking about Trump not releasing his taxes because he does business with Russian oligarchs. You'd think that he just put it in a holding company, wouldn't you?
I mean, that could be true, but, I mean, when you don't release your tax returns, there's a reason for doing it, right?
Sure.
It's either because you don't want people to see how much money you make or how little money that you make, in Donald Trump's case, because he claims to have a lot of money, or you don't want to see all the connections to other entities that he has that would paint him in an unfavorable light. So That's pretty much it when it comes to tax returns. So I don't know, and we won't know until he releases them.
Yeah, more to come, more to come. Andy, thank you very much. Enjoy Michigan.
Indeed. It's trying to cool off here, Catherine, trying to cool off.
Oh, I'm sure.
Okay, folks, we're going to a break, and when we come back, former U.S. Fed insider Danielle DiMartino Booth, and my chat with Matt Hendricks of Sprott Asset Management. Stay with us. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Another big story, of course, on BNN today is the Fed. They have done as expected and left rates unchanged. And our next guest says she doesn't see the rate hike this year, despite however much the Fed would like to move. Joining us from New York is former Dallas Fed insider Danielle DiMartino Booth, and now president at Money Strong. Danielle, great to be with you today. Thanks so much for joining us.
Thanks for having me.
Danielle, let me get your take in terms of what the Fed can even do. We keep focused on whether they'll raise rates or not this year, but from your viewpoint, it doesn't sound like they're going to be able to at all.
You know, I think the Fed has been boxed in for a good long time. There always seems to be a reason to not hike rates. I think that at this point, over midway through the year, I think Janet Yellen was desperately hoping that oil prices would be well above where they are and closer to $60 a barrel rather than where they are today, which is closer to $40 a barrel. So you've still got that lingering pressure on inflation rates, and they nod it to that. But again, today the buzzword is diminished. And the threat of the September rate hike is clearly out there. I think they really would like to move before the election, but we'll have to wait and see what these next two jobs reports reveal, because they remain highly data dependent.
They do. That's what they've said. That's what they continue to do. So we should believe them by now. But, you know, at the end of the day, can they really be raising rates when you've got essentially every other central banker in the world adding stimulus to their economy? And all that does is create a continued negative feedback loop for that stronger U.S. dollar. Is that really what they want to go through again?
You know, it absolutely does. I think that we're seeing this kind of start and stop manufacturing activity in the country as it's whipsawed by the movement in the dollar, and other central bank activities, to your point, make the situation for the Fed very, very difficult.
So what do they do next? And I want to bring in the fact as well, I was reading your notes, that you hosted a dinner last night. Art Cashin was there. I think a lot of people probably know and recognize his name. He's been in the business so long. What does he think and say? What were your conversations like with him?
Well, you know, we actually talked about several things last night. Art and I are on the same page. Neither of us believe the Fed's going to be able to hike rates this year. He's been saying that all along, and of course I agree with him. But we talked a lot about inflation and the inflation metric that the Fed prefers to use to make monetary policy that they never seem to be able to get in front of, and whether or not at some point in our future there will be a recognition that they're relying on the wrong measure of inflation, and that's what's allowed them so many times since Alan Greenspan took office to keep rates too low for too long. We were just listening to information about the Vancouver housing market. Too low for too long, and you know, it means that speculative money is going to flow into places where it doesn't belong for too long, and you know, create bubbles here and there.
Yeah. Well, what do you think is the right metric that they should be using, whether it's for inflation or maybe it's a completely different metric altogether?
Look, I don't know that they don't go back to the drawing board. They've got over 1,000 PhDs. Surely they can come up with a better mousetrap. You would have to think. You know, I was at the Dallas Fed for years. The Dallas Trim Mean is a much more realistic measure of inflation than the PCE or the core PCE, for that matter. But none of these inflation gauges that are out there today take into account asset price inflation. And you know, that was one of the leading causes of the financial crisis of 2008. And again, it's something that they haven't fixed. You have to recognize asset price inflation.
What was one of the leading causes of the financial crisis? That the asset prices got out of whack, but how does that really translate into what the Fed's role is or not?
Well, it wasn't that obviously asset prices got out of control but before the crisis, but it was the fact that the measure of inflation that the Fed was relying upon to make monetary policy didn't capture that in any way, shape, or form, and it doesn't capture it today.
What do you think is the real rate of inflation, or what should we be looking at?
That's really hard to say, but I can tell you that it's appreciably higher than what they're looking at. Look, we've got rental inflation in this country, according to the CPI, running at 3.8% year over year. Look, Houston, we've got a problem. The cost of sending your children to college has completely skyrocketed. Healthcare costs have gone through the roof. So I think for the average working American, it's literally insulting to hear that inflation remains too low, or that it's uncomfortably low for the Fed, because the cost for basic necessities, at least when it comes to paying the rent and paying the iPhone bill and sending the kids to college, those costs have increased tremendously in recent years.
We need a new basket of goods to calculate inflation. Because I agree.
More realistic.
I agree with you. I think it's really insulting to a lot of people who are trying to make it on their incomes and on their salary, and things just keep getting higher and more cost. But if you're actually on the ground working like everybody, not the Fed, it's a very different inflation feel versus what they're telling us. But the question is,
there's the insult to injury there, Catherine, that if you're on a fixed income and these costs continue to increase and interest rates are at 0%, you can't make any money on any kind of safe savings. So grandma's out there aiming for the fences buying junk bonds.
It's true.
It's a huge conundrum.
I know. If we'd had that conversation 10 years ago, you'd never believe that we were selling junk bonds or someone selling junk bonds to grandmothers. But Daniela, how does this play out? Like, when you sit back, and we can understand that there's issues and that there's problems, but what aren't we talking enough about? And I wonder if it's to the point of senior citizens who really can't afford their fixed income lifestyle, if we're not even talking about the poverty that whole group of demographics might be facing. What are you guys talking about? Are you looking at that, and how much?
Oh, look, the finance minister of Germany has come out and said, if you persist down this path of negative interest rates, German life insurance companies are going to start going out of business in 2018. Think of the tremendous pressure that life insurance companies are under, that public pension funds are under, that private pension funds are under. To me, that's the biggest elephant in the room, is that you've got this brewing catastrophe out there while you've got the baby boomer generation no longer able to say, hey, you know what, I'll just stay in the workforce. They did that once. But now they're beginning to turn 70, and some of them are simply incapable of staying in the workforce and need to retire. And this will become a huge public policy situation. Meredith Whitney, she probably was wrong to ever put a timestamp on it, and we've all learned our lesson from her. But just because you're early doesn't make you wrong. Yeah, I know. She's been early on a couple things, and it's benefited her. And then sometimes people make too much of negative headlines about it as well. But we'll leave it there, though. She's done some good work, for sure. Good to be with you today, Danielle. Thanks so much for joining us. Thank you for having me. Appreciate it.
And now to Matt Hendricks. I'm joined by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. Are you, Matt?
Doing well, John. How about you?
Great, thanks. And I attended a gathering that you hosted on Wednesday for investment advisors here in Ottawa, and the speakers were Paul Wong, who manages the Sprott Gold and Precious Minerals Fund, and Eric Nuttall, who is the portfolio manager of the Sprott Energy Fund, and they were first-class presentations. Could you give our listeners an elevator version of those presentations?
Well, for sure, John. It was a very successful event. Eric Nuttall talked about, it was actually very timely, seeing how oil has pulled back from 50 to 41, and he explained to our advisors how he sees oil still by the end of the year at 60, maybe even $65, and how he runs money in the energy fund. He uses cash a lot, so actually during this almost 20% pullback in the commodity, his fund is only down 3% in that time. So he's done a great job protecting the downside. So you know what? He's just a quality stock picker. He uses cash when he gets scared of what he sees out there, and he's just been posting unbelievable returns for our clients, as he's got the number one return in Canada for over 1 and 3 years. And Paul Wong's message is that we are definitely in a precious metals bull market, depending on how you look at it. If this is an average bull market, then we're only in the third inning. If it's an above-average bull market, we could be only in the first or second inning. So there's hopefully lots of great returns in both of those strategies in the next few quarters.
And the point, for instance, with the Gold and Precious Minerals Fund, which is up about 100% or more this year, if you had 10% of your portfolio in that fund, your overall portfolio would have 10% added to its total value.
Absolutely. And another great soundbite that Paul Wong gave us was the fact that the TSX, which has 8% exposure to gold, that 8% exposure has given the index 60% of its returns this year. So I'll give you those numbers again. 8% of the index has given 60% of the year-to-date return. And gold, as an investment around the world, is well under that, is so under-owned, it's not even funny. And even if people wanted to get an 8% weighting, it's almost like they can't because there's just not enough to go around. So I highly recommend that clients talk to their investment advisors, and those advisors get an allocation to precious metals.
Now, for listeners and advisors who'd like to avail themselves of your advice, how do they get a hold of you?
I'm always available, John, toll-free at 1-866-299-9906, or always remember to visit sprott.com.
Thanks for joining us. Enjoy the rest of the day, and we'll talk same time next week.
Happy Sunday, John.
After the news, Eric Nuttall, who's the portfolio manager of the Sprott Energy Fund. Stay with us, folks. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
We are back with Eric Nuttall. He's a portfolio manager at Sprott Asset Management. He specializes in the energy world. And you're an oil bull, and you're actually willing to use the phrase spike a couple of years. When you look a couple of years out, you see the possibility for a crude oil price spike.
I do. When I was coming on the show in January, February, saying $50 by year end, it seemed heretical, and we obviously got there a few months ago. Looking out beyond now, when you look at the extent of the cuts in spending around the world towards larger projects, like outside of North America, it's not really well by well, it's really field by field, and these wells and projects take several years to bring on stream. But from the time of discovery to actual production, it's now around 7 years for a large mega project. And now that we're 2 years into an epically bear market for oil, we've had 2 years of project deferrals. So the visibility of those production adds coming on from those large projects outside of North America is very visible. So when we look beyond 2017, there's about 2 million barrels of new production coming on. That falls to about 1.5 in 2018. And when you look at 2019 and 20, it actually gets down to around 1 million barrels, which sounds like a lot. But demand historically grows by about 1 million. And at the same time, the world always, or the industry always faces a problem of having to offset production declines. So generally speaking, the world consumes, it's around 96.5 million barrels. And that falls by 4%, the production capability, just from the loss of natural reservoir pressure globally around the world. So you need to come up with 4 million barrels of new production just to stay flat, in addition to 1 million barrels of demand. So that's 5 million barrels. The most I think the U.S. can grow is 1 million barrels per day. That would take 2 years, and that's running like full out without any logistical problems, labor problems. That's like in a fairy tale world. So 1 million comes from the U.S. We've got 1 million to 1.5 million coming from non-OPEC, non-North Americans. So now you've got 2.5. You're still short another, let's say 1.5 million to 2 million barrels. And when you look inside OPEC, let's assume currently now it looks like Saudi Arabia is tapped, and there's reports from Morgan Stanley suggesting that their export capacity will actually be falling between now and 2020, Iraq for the same issues. So we're really praying for peace to break out in either Libya or Nigeria. Nigerian production now is close to a 27-year low. Supposedly the Delta Ventures have come to a ceasefire temporarily, but over the weekend they were blowing up more pipelines. Mm-hmm. And then in Libya, production is still down 75% from the kind of the post-Gaddafi high. So without those two areas coming on, I'm highly challenged to see where you're going to get a meaningful production adds 2 to 3 years out to meet global demand and offset global declines.
But how dependent is your forecast on the geopolitics and the conflict in Libya and Iraq?
Well, right now the market is undersupplied with Nigeria being off. When we fast forward, given the continued declines in the United States, so U.S. production now is down 1 million barrels per day from the high. that trend should continue by roughly 500 to 100,000 barrels per day per month. But it's not just the U.S. Like when we look at areas like China, China is the fourth largest non-OPEC producer. In the month of May, their production was down 300,000 barrels per day. In China, we always talk about a demand never supply. They're the fourth largest non-OPEC producer. Why was production down? It wasn't social issues. The government's mildly capable of quashing that fairly quickly. It's an industry that's underfunded, not able to spend enough and offset decline. So that decline in the May for China was the largest drop in 15 years. Venezuela has the same issues. It's not necessarily social strife yet. Their production in the month of May was down around 120, 130,000 barrels per day. That was the biggest drop in 10 years. So it's not just the U.S. Production around the world is falling off of a cliff due to either geopolitical issues, but more importantly, an industry that's being starved of cash flow and that is always constantly every day battling this decline issue.
Now to Kevin O'Leary in conversation with BNN's Catherine Murray.
The CMHC sees moderate evidence of a problematic Canadian housing market, with Toronto and Vancouver both showing strong evidence of being overvalued. Joining us now for a closer look is Kevin O'Leary, chairman of OLeary Financial Group. Kevin, good to be with you today, and it seems though every day we're getting more and more organizations, groups that we do respect, saying there could be a housing problem in Canada. And do you still not want the government to do anything about it?
No, I don't. I want the market to do something about it. I've never found that a group, an analyst, either someone involved in the trading of houses are more effective than the market itself. If housing is truly overvalued, the market's going to let you know. And, we have to be prepared in a capitalist society to take on some volatility in markets like this, and that does occur. That's the nature of capitalism. But for the government to try and control the volatility of housing pricing, not only has it never worked, it actually causes a lot of damage and loss of value to participants who have actually put their own money up. And I'm concerned about people who have bought houses in the last 3 to 4 years. And so the last thing I want is job owning from the government to decide what price the house should be. If that's where we're going, Catherine, I would rather have the government buy all the houses. They can determine what they want to rent them back to our people at, and they should take all of the market risk, and that would make me feel a lot better. And I could go down to the river and eat some government cheese, too. That's not the kind of country I want.
I don't think it needs to be so black and white, so binary. Why not just start to implement a few measures or continued measures, because this has been tried and it hasn't maybe worked, but some measures to continue to try to slow down the housing market. I mean, it seems though it's not possible to do because you've got these lower for longer rates, and human nature is they're just going to go out and buy at a high price. That's human nature. It's hard for government to do anything about that, I would agree, but why not try? Why not try something more?
Because what it means is we're going to end up with the Ministry of Government telling me what the housing price is. Very, very bad outcome. Well, we don't want some bureaucrat sitting in Ottawa that...
They're not going to tell you. They're going to slow
down. That's exactly what they're doing in BC.
Slow down these spiking prices.
And they know how to do that. Thank goodness we've got good government officials that know how to control, manipulate markets, just like they know how to control the Canadian dollar. If they're so damn good at that, why can't they get the dollar back to 106?
Because they don't want it there.
Because the market has decided Canada is worth less today because the price of oil has declined, and most of our provinces are having their bonds downgraded, so there's less demand for Canadian dollars because we have very bad political management in our fiscal system. So the market decides. Now, if the Canadian government thought they were so damn good, then they should be able to talk up the price of the Canadian dollar or control the price of housing. Or how about this? Why don't we ask someone in Ottawa to control the price of oil for us, Catherine? Why are we messing around with housing?
Well, because oil is a global commodity. Forget that. Nobody can talk up the price of oil, really. With the Canadian dollar, clearly they don't want to.
So why can they talk up the price of housing?
And clearly the Canadian dollar is also lower on the fact that the U.S. Fed might actually start to raise rates, or at least that's the perception. Plus, you've got oil declining. Of course, the Canadian dollar is lower. Nobody should be able to talk that up.
Well, I'm sitting here in New York right beside the NYSE, and the Fed did not raise rates. The same environment that we still have, that means housing is going to continue to go up. I tell you, Catherine, mark my words, save this tape, this is going to end badly. Housing prices are going to have a massive correction if the government keeps meddling with the pricing, and then we can go point to the finger of whatever minister decided to make this stupid move. He's going to hurt Canadians, and then he's going to lose an election. That I'm okay with. I love to get rid of bad managers this way. You know the thing about politicians, you can't fire them. You have to wait till they make mistakes, then you throw them out. In an election, I'm okay with that.
I know you're okay with that. Let's just talk briefly about the Fed. No real change. I think slightly hawkish on the margin. Gold pulled back, but then it resumed its upward march. Markets are moving up a little bit higher now as well. What do you do with the Fed these days?
Well, you're right. You're right about the new language, those two sentences, a little more warning. I think we could have sustained a 25 basis point hike here. It would have been a confidence giver to the economy, which is doing quite well in the U.S., hovering around 2.1% GDP growth. Earnings were good. And so I was anticipating maybe they'd make a move and make a surprise and make it sound like it was a vote of confidence for the U.S. economy. That didn't happen. We had a really bad 2-year bump, which means people are getting concerned. The Fed is getting erratic again.
Kevin, with respect to U.S. elections, DNC, what are you watching for with the Democratic National Convention?
Well, I must say they put on a very good show. The Democrats, and culminating last night in Clinton's speech about his wife, which was really heartfelt. But where it's not resonating is with the Bernie Sanders supporters who are still unhappy, and also a really new twist. Millennials aren't really engaged in this whole, I met her in the 70s and we dated for a while stuff. They want a job. And so I think the message starting tonight, what I've heard through my Boston connection, is we're going to get more policy tonight. We're going to start to hear about how Hillary and the team is going to work on getting jobs back into the economy, growing the U.S. economy, how they're going to play safe, the concerns that Wall Street has with Bernie's and Elizabeth Warren's followers.
Right.
I think they're doing a very good job, though. I think it's been very well produced, and it has not shown up in the polls yet, but we'll get new flash polls next Monday, and we'll see what the effect of this whole thing is going to be.
All right, we got to leave it there. Kevin, good to see you. Thank you.
Folks, we'll go to break, and when we come back, Daniel Morgan, who's Senior Portfolio Manager, Synovus Securities. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
The numbers have now hit the tape. Facebook Q2 revenue comes in better than expected at $6.44 billion. $6.01 billion was the street's consensus. But I'm looking here at what appears to be a substantial beat on the bottom line as well. We were looking for 82 cents per share. 97 cents on an adjusted earnings per share basis is what Facebook is giving us this time around. And to your point about the mobile and the daily active users coming in at 1.13 billion, which seems to be in line with most expectations, and the mobile daily active users at 1.03 billion. Daniel, what do you make of that first blush number?
Well, I'll tell you, Michael, looks like another blowout quarter just based on the data points that you just mentioned in terms of Facebook. I mean, they had a blowout quarter in the first quarter. It looks like the second quarter from earnings and revenue, and you mentioned some of the user data looks very, very positive.
And mobile ad revenue is 84% of the ad revenue, which is a little bit better than some had anticipated. How much more can they squeeze out of the mobile side of things on that revenue line, Daniel, considering 84% is quite a remarkable figure in and to itself?
It really is, because first quarter they were 82% of revenues was mobile advertising. Now they go to 84%. And you know what's interesting, Michael, is I've been following the stock since it went public. Initially, the reaction to mobile users was negative, meaning they weren't getting as much revenue per ad on mobile as they were on desktop. But now everyone has moved, as you mentioned before, checking their Facebook page on their mobile device 17 times a day. Everyone has moved over towards mobile, so now mobile is hot, and they're getting nearly 85% of their advertising revenue from the mobile sector, which initially was looked down upon when we started looking at Google and Facebook and some of these other players. They wanted to gather more revenue on the desktop.
Capital expenditures came in a little bit shy of estimates at $995 million versus the consensus of about $1.04 billion. How comfortable are you with them sort of pulling back on the spending overall? You mentioned Oculus, by example. I've just gone through the quarterly results. I did a search for Oculus. Not once does there appear to be a mention of it.
Yeah, I mean, it's kind of interesting because Facebook in some situation is somewhat like Google, where they're starting to expand into some of these other areas, and they've also been guiding that their operating margins may move more towards 30 to 40% as it relates to some of these virtual reality things. Also, Messenger and WhatsApp aren't quite as profitable as their advertising business. So it's interesting to kind of follow that in terms of impact on margins, and when margins start to kind of come back a little bit in relation to some of the costs associated with those kind of newer initiatives.
We appreciate your insight. Good to have you with us. Thank you, Daniel.
Okay. Thank you, Michael.
Daniel Morgan, Senior Portfolio Manager at Synovus Securities. And again, beating the street on the bottom line and the top line. Daily active users, monthly active users coming in stronger than expected. Stock is up 7% after hours.
Now to BNN's Christina Parts.
Facebook beat the street on the top and the bottom line, blowing past estimates. For a closer look with the breakdown of the numbers, we're turning now to Christina Parts,
who does not own Facebook and really wished I did buy it at its IPO price of $38. Now it's soared well past that. What we're seeing is out of 17 quarters since it went public, Facebook has beat analyst estimates for the past 16 quarters. So it was literally just one quarter where it didn't beat analyst estimates. So what we're seeing today is the market reacting very positively in after-hours trading because they had adjusted earnings that came in at 97 cents per share on revenue of $6.44 billion, well above expectations. The market cap right now is tracking around almost $375 billion, which does put it ahead of ExxonMobil. So that's a big thing. It would be the number 4. And if it continues this gain, it could hit record territory.
It looks like the big thing the street's happy to see, though, is the fact that of that revenue pie, the vast majority of the money coming in the doors from the mobile ads.
Precisely. Mobile, about 80% of it. Mobile 84%, but mobile ad revenue is up 81% compared to last year. That is a huge increase. And so what we're seeing, the daily active users hitting about 1.13 billion users per day. If we look at the mobile segment, though, because that is a big segment of Facebook right now, and we look at the monthly numbers, there's about 1.57 billion people that are turning to Facebook on their phones every single month. And they still have a lot of cash on hand, about $23 billion in cash and equivalents. So why am I saying that? Because Facebook did buy Instagram, they bought WhatsApp, they bought Oculus, and so these are all big acquisitions, but they essentially can go out and buy some more without diluting shareholders' values, essentially. And so you brought up mobile. Zuckerberg did make some comments about mobile, and he said it really does have to do with video. So they have been pushing with the Facebook Live and implementing videos onto the screens, because you can literally take a video now and post it just on the timeline. And so that's been a huge strength. They don't break out the numbers for Oculus, so that would be the hardware as another source of revenue.
VR,
yeah, the VR, which you've used before. But this big beat raises the question as to how Alphabet is going to do tomorrow, because advertising revenue just did so well with Facebook. Does that mean that Facebook stole revenue away from Google, or is the pie getting so big so quickly? Thank you.
Christina Parts, an analyst.
And to conclude today's show, we go to John Petrides, who is Managing Director and Portfolio Manager at Point View Wealth Management.
John Petrides is the Managing Director and Portfolio Manager at Point View Wealth. He's actively been following both these companies, and he joins us now. Good to have you with us.
Thanks for having me on.
Amazon.com had a big bar to clear on the top line. Looks like they leaped past that. On the bottom line, how do you feel about that beat, considering that wide range I was talking about?
Well, Amazon is not a company you invest in for the quarter. Amazon is a company you invest on for the next 10 years. But expectations had been very high. Amazon had a huge 2015 from a stock price performance standpoint. It was up 10% entering the quarter. They beat on the earnings and the revenue expectation. And I think investors in this sense just wanted more. There's a tremendous amount of expectations into the price from a valuation standpoint on Amazon. And the fact that their next quarter guidance is simply in line is probably not enough feed to feed the fat cow here.
Amazon Web Services, how critical is that to you?
Well, that's the key growth story, I think. I mean, the company on a run rate is only at about $10 billion from a sales standpoint, and that market is significantly larger than that. So, that is going to be because the web hosting service, that business model in and of itself is a pure cash cow, and Jeff Bezos will be able to milk that to use it to work on some of his other projects that he likes to fund for free.
I'm trying to get a sense as to the breakdown of AWS in the whole thing, and they're not really breaking it out. That's usually a concern to me, but I'm looking now at net sales coming in at $2.8 billion.
Right.
How does that jive with your view on, and the bottom line came in at $718 million?
Yeah, that is, on the AWS, that's above, where the run rate was on last quarter. They were at $2.5 billion. So, they continue to grow in that space. I'm more interested, I think, at this point on Amazon Video. The key, Amazon is one of the most disruptive companies in the world. And most people focus on the retail aspect and think like, well, the boardroom of Walmart must be concerned of what's going on with Apple. But it doesn't stop there. When you look at mall REITs, in the U.S., Simon Property Group is the largest mall REIT in the world. Their board has to be talking about Amazon all day long. The cloud storage companies have to be talking about Amazon. UPS and FedEx, the delivery companies, are talking about the Amazon impact. And now, because of the video presence, you have to be thinking that the cable companies are very worried about Amazon and customers cutting their cord.
Are you concerned about them throwing a lot of money at original programming, or is that just the cost of doing business?
That's the cost of doing business, but I think it's an effective strategy because I think the model, the way we are and will watch TV is evolving. And what Amazon does is through the Prime service, not only do people, our Prime subscribers, simply to get free shipping for $100 on the year, you get free video and free music. So it's also eating at the iTunes ecosystem because what I may have on my iPad, my son can download free on his Prime. And now, if you translate that to the Fire Stick, and you could download all this content onto your television, you get it all for free. Well, it just makes a very, very compelling offer for consumers.
I'm looking at Alphabet, the parent of Google, up by 5% in the after-hours session here. Their paid clicks was up by 29%, about 200 basis points more than expected. And their paid clicks, cost per click came down greater than expected, 7%. How is Alphabet managing the lower margin nature of the mobile ad space?
Well, the Amazon quarter was similar to the Apple quarter that we saw earlier in the week, in the sense that expectations were fairly low, and Alphabet, I think, beat on almost every metric here, which is why you're seeing that huge rally in the stock. I think that Amazon, Alphabet, similar to Amazon, again, is a very, very disruptive company. The business model is set up to be a pure cash cow, and I'd have to dive deeper into the call and hear what management has to say. But clearly, this is a great reaction to the stock.
As a geek, I was really apprehensive about this. As a stock jock, I'm sure you were pleased that the company created this Alphabet umbrella company so that they could better break out the money they're throwing at those moonshot ideas. And with Ruth Porat, the new CFO, curtailing the moonshot cash, are you not concerned about the company not being able to find the next big thing?
Well, I really appreciate you separating the geeks from the financial guys because from a finance standpoint, from a shareholder standpoint, you have to love the new CFO because she's reining in the geeks. With the amount of cash that Google can spend, they could be throwing moonshots all over the place and be beta testing as many pet projects as they possibly can, and she's reining that in, which is a very, very smart thing to do, and focusing cash flow on a higher ROI type of investments. I mean, Google has moonshots and Other and Google X. I mean, how many more pet projects does the company need? So we get it. Google wants to be Bell Labs of the 1950s, and they are. It's just, I think sometimes a company can go too horizontal, and at some point you need to go vertical on some of these projects.
We appreciate your insight as always, John. Thanks for joining us.
Thanks for having me on.
John Petrides is the Managing Director and Portfolio Manager at Point View Wealth Management, joining us on the phone from his trading desk.
That's it for Money Talk. Thank you for joining us this afternoon. Have a safe and fun weekend. We'll be back next Sunday, 2 p.m., I'm John Budden, and you are listening to 580 CFRA.